Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week of June 20th. So we had a pretty nice bounce this week where all the major indices had a nice move to the upside. Question is, do we continue up from here going into next week, or are we going to roll over and continue the bear market blues? So let's take a look at some of these charts and see what we can find out. So starting out with the S&P 500, we are coming up against a couple of somewhat significant resistance points in the market. We did clear this 390 level and closed just slightly above it on Friday, so it'll be interesting to see if we can hold that level and get up and head up further from here. We also have this channel to the downside we've been tracking. We had a nice breakout back in May up that last channel, and then we saw a nice little bounce. So if we do see this second channel here kind of clear with price action, then I'd be looking for maybe a little further upside, probably looking for potential resistance at the 50-day moving average, and if we do manage to get above that a bit, I wouldn't probably expect it to get above this Fibonacci level at about 414.50, but really looking at probably that 50-day moving average as a key area of potential resistance. That still means we could get a decent little bounce from here. If we hit the 50-day, we could be looking at another 4% or so on the S&P to the upside before we likely head lower once again. And then taking a look at the NASDAQ, the triple Qs, we are hanging out in this channel to the downside. We are much closer to the 50-day moving average as well, and so if we do continue to see the NASDAQ break out from this channel, I probably would expect it to be fairly short-lived. Probably wouldn't. I'd be somewhat surprised if it got back above that 303.75 level, which will likely coincide around that 50-day moving average as well. So that's what I'd probably be looking for as far as a potential top in the NASDAQ. And then taking a look at the Dow Jones Industrial Average, we did clear a major Fibonacci extension level right around the 311.60 mark. So as long as we're above that on the Dow Jones Industrial Average, then I think there's a good chance we head up to at least that 50-day moving average for potential resistance. And so for the industrials, that probably represents about another 3.5% of upside potentially in the Dow Jones Industrial Averages. And then taking a look at the Dow Jones Transports, we definitely saw a nice bounce off of that this week. We bounced off of the 150-week moving average pretty nicely 2 weeks ago, and then had a nice move to the upside off of that, holding support. And so the next level we'll be watching on the transports will be to see if we can get back up into this kind of trading channel range we've been in for so long. So we'll be looking for some probably significant resistance at that 14,350 level. We'll likely roll over from there, but if we do see it get back above that 14,350, that would certainly be a pretty bullish sign for the markets, I think. And then taking a look at the Russell 3000, we've been talking about this one for quite a few weeks. This is a trend channel that goes all the way back into the financial crisis of 07-08, and so this has been a chart that's been the price actions respected this channel for quite some time. We did see a little bit of a dip briefly below it during the COVID crash, but for the most part we've seen some really strong price action within this range, and the yellow line represents the middle of this channel, which we expected either a pause or a bounce off of that, which we did. Then we did fail a couple weeks ago, drop below that level, but then we obviously had a strong recovery this week and a nice bear market rally. So the question is going to be, do we hit this center channel and then have that act as resistance and then roll back over? My guess would probably be yes, but if we do see it break above that center channel, then maybe we do go back up and retest either the 50 or the 100-week moving average. But I still think that we've got more pain to the downside and likely will end up at the bottom of this Russell 3000 channel before the sell-off is over in the markets. And then taking a look at the Russell 1000, we had a nice rally in large caps this week. We were heading all the way down to the 200-week moving average, but we got a nice bounce this last week, and so we'll keep an eye on that going forward. If we do continue this rally, looks like there's some decent upside opportunity in large caps, but I'd likely expect a rollover once we got back up to this 100-week moving average, which likely coincides with that Fibonacci extension level around the 231 level. And then take a look at small caps. We had a pretty bullish development there in small caps this week, as we've been talking about this 173.55 level as a real key area of support and resistance. And that did fail last 2 weeks ago, and we fell pretty hard off of that and fell down quite a bit. But this last week we had a nice rally and recovered all those losses and actually got back above the 173.55 level, closing the week at about just above 175. So it'll be interesting to see if we can hold that. If with small caps can hang on above the 173.55 level, I think that's fairly bullish in the short term. Might indicate we've got a little bit more upside in the markets before we roll over again. And then taking a look at our growth versus value chart. So growth has been a difficult space to be in, going all the way back to about November of last year. But we have seen a few bounces where growth has outperformed. Last time we saw that was in March of this year. But really over the last 3, 4, 5 weeks, we've started to see another bounce in growth, starting to outperform over value. We also got above this key level at 153, and it now should act as support. And so as long as we stay above that 1.53 on this ratio chart, then we could continue to see growth outperform value in the short term, at least, before we likely head lower. And then jumping over to our sector charts that we look at. These are a variety of different sectors we like to track in the markets. This is representing the last 10 trading days ending June 24th. And so we can definitely see some leaders over the last couple of weeks. We talked about last week how biotech was starting to show some signs of life, and that's continued, and that's actually the market leader now over the last couple of weeks, with biotech up almost 10%. So I've definitely been checking that sector group out, looking for some trade opportunities in biotech, and I'll be kind of keeping an eye on that here in the next few weeks. We also saw a nice bounce from the ARK Innovation ETF, which that's obviously been one of the hardest hit areas in the market this year. So we did see a nice little rally out of the ARK Innovation ETF. We also saw global lithium do really strong over the last couple of weeks with almost 5% upside. And we also saw cloud computing do pretty well, 3% upside. And then scrolling down to take a look at some of the worst performers. As we know, energy really rolled over this last few weeks, and so most of the energy sectors are down 20 to 30%. Nat gas being the worst, with a drawdown of about 30%. But I still don't think that these are indicative of the energy trade being over. I think this is just another correction. We talked about it in a short video. We actually did a trade opportunity call out on ticker RRC. So I'm buying the dip in energy. A lot of them have hit their 200-day moving average and they're holding. And so as long as these energy stocks are holding above the 200-day moving average, I think it's a good buying opportunity. Get some energy stocks into discount, and hopefully we'll get another big move to the upside in energy, as I don't see the supply-demand imbalances in the energy space getting resolved anytime soon. Some of the other sectors that we've seen the worst performing for the last couple of weeks: steel down almost 15%, metals and mining down almost 12%, and then we've also seen other hard-hit sectors like materials, home builders, agriculture, semiconductors, and the global auto fund all down anywhere from 5 to about 9% on those. And then jumping over to the U.S. oil chart, another reason I think the energy trade is not over. We did see 2 big drawdowns in the price of barrels of oil, which is great for hopefully some gas pump relief in the short term. But unfortunately, at least for gas prices are concerned, I think we are still heading higher. We have been kind of chopping around in this range for a bit, but we did resist off that 124.42 level, which we'd identified, and rolled over from there. But we did see a pretty big sell-off on the week in oil, but a lot of that recovered and ended up the week at about 107.50 a barrel. And so I think this is just a short-term correction in oil under a longer bear market or bull market cycle in the energy space. And I still think that there's a high probability we get back to the all-time high right around the financial crisis time period. I think 07-08 was when we hit the previous high at 147.50 a barrel, and that's still probably my bet that we are likely to head up to that level, or at least back up to the 124.42 Fibonacci level. So those are kind of some areas that I'm targeting. I still think we've got some more trade left in the energy space. And then jumping over the commodities, the CRB Index We've identified this 313.70 level as a really important support and resistance area. We talked about previous weeks about being patient and looking to enter new trades in the commodity space once we broke that. But then we did see a pretty big rollover these last 2 weeks, and now we've lost that as support, and we have headed down quite a bit lower. So commodities at large, it's not just oil, but a lot of commodities are starting to correct a bit. This channel here in the center, though, was acting as resistance for quite some time on the ride up, so it'll be interesting to see if this ends up being the support level. If we see commodities drop below that center channel level, I think that would be a little bit more concerning to the commodity picture, but otherwise I think it would make a lot of sense for us to head back down to the center channel, most likely act as support, and then we likely see commodities head higher from there. And then taking a look at our consumer discretionary versus our consumer staples, we've seen in this chart for weeks on end that this has been in a clear downtrend since November of last year. And so if we really want to see any kind of sustained rally in the markets, I think we're going to need to see this channel line broken, and we clearly haven't broke that, and it's been a pretty steep decline since November. So I think there is some short-term opportunities for some upside, but it's likely just a short-term opportunity until we really probably see this channel break and start to see some big movements to the upside. Consumer discretionary is more of a risk-on sector, whereas consumer staples are defensive. And so anytime staples are outperforming, people are being a bit more defensive and cautious in the markets and a little more risk-off. Then we take a look at our all-world ex-US, so this is the global stock market minus the United States. We did see a bit of a bounce globally this last week, where it looks like we put in at least a short-term bottom, and we're starting to move to the upside again globally. But when we take a look at it on relative terms, we actually had seen a little bit of a trend emerging where the emerging markets were actually outperforming the S&P 500 on a relative basis for a few weeks now. But this last week we saw a pretty big change in that, and so it looks like the U.S. markets rebounded a lot more than the emerging markets did, and so we've actually started to see that relationship roll over, and so we'll have to keep an eye on that. But it's looking like this trend of emerging markets outperforming the United States is at least at a pause, or it may be turning over again. And then taking a look at our high yield corporate bond chart, we've talked about this one, about how this 75 level was a real key area of support and resistance. We failed off of that last week. We talked about in a previous video how we thought that was a bit of a warning sign to some more pain in the markets. We did get back up to this level and kind of hit that, acted as resistance, and so we didn't quite get above that level yet. So it'll be interesting to see if we can get above that 75.11 level going into next week. If we do, then that might be a bit of a sign that we've got a little bit more of this bear market rally in place. But regardless of kind of where this chart goes, I think it's pretty clear to me that we've still got some more downside broadly in the markets, and this HYG chart is quite a bit off of moving averages, and I think that's been a really reliable warning sign, as we saw that break the moving averages back in January of this year. That was one of our big first warning signals that the markets were starting to look a little rough. And then when we take a look at the HYG on relative terms compared to traditional bonds, so that's corporate bonds relative to traditional bonds, treasury bonds, we're looking at this relationship chart and this channel that we've been kind of trading in for quite some time. I think the next leg down in the markets will likely see this channel break. And so if we see the HYG divided by IEF drop below that 0.73 ratio, then I think that'll be our next warning signal that the markets are likely headed on the next leg lower. But what we saw this week, we got all the way down to that level, and then it actually acted as support and bounced off of it pretty convincingly. So I think for now that's a pretty bullish signal for some short-term opportunities in the market. And then jumping over to the metal space, gold's not really doing anything. It's down a little bit on the week, but it's really just been kind of trading in a very tight, choppy range for the last month and a half or so. We did see a bit of a drawdown maybe a month previous to that, and so really I'm not looking for any opportunities in the gold space until we get above that 186 level on the GLD. And then similar story for silver. We're trading around in a pretty tight range, right around that 200-week moving average. which is right at around $19 an ounce. So if you're looking for a long-term buying opportunity, as long as we're above that 200-week moving average, I think that's actually a really good entry point for silver if you're looking much more longer term. But this could also just kind of chop around in the sideways range for a very long time, and so I'm not really looking to put any trades on in the silver space until we see a lot more bullish developments and get back up above, say, about 24.25 an ounce. And then we're taking a look at the TIPS divided by the IEF. So this is a ratio chart that we look at. So the TIPS is inflation protected bonds versus traditional bonds. And so when this chart's going up and to the right, it's telling us that inflation expectations are rising. And so we've seen a bit of a change in that over the last few weeks. And so we've been keeping an eye on that. And so at least right now on this chart, it's sort of suggesting that at least a rapid increase in inflation is slowed down at least, but it wouldn't take much to change that. I mean, if we got back up above the, say, 1.15 level on this chart, then I think we could immediately be heading higher on rates potentially, but we'll be keeping an eye on that one as we are just below that 1.14 level that we've been watching. And then taking a look at the dollar. Dollar kind of had a bit of a break above the 105 level. It started to look pretty bullish for the dollar, going even higher, but then it kind of had a very choppy range 2 weeks ago, and then this last week it started the week out higher, but it ended up finishing the week lower, and it's kind of in between these two levels we've identified at about 104 and 105 on the dollar. And so we'll be watching that one pretty closely. If we see the dollar drop below that, say 103.85 level, then that could be potential bullish signal for stocks. Usually when the dollar's dropping, that's usually a good opportunity for stocks, and when the dollar's rising, it's generally more bearish for stocks. And so we'll keep an eye on that and see. Right now it looks like it's just chopping around in a sideways range between that 104 105 range for now. And then taking a look at our interest rates, starting out with the 2-year, we did drop pretty low. We kind of looked like we put in at least a short-term top 2 weeks ago, and then this sold off further into the week, but a lot of those drops in the 2-year ended up recovering, and we ended up closing the week above this key level we've identified at about 2.98%. And so as long as we're above that level, I think there's a good chance we're still headed higher. So this looks like it might just be another short-term correction before we head a little bit higher on rates. And when we take a look at the 10-year, similar story, really across the board on all these different time periods. They all kind of look like they put in a short-term top 2 weeks ago, sold off a little bit more this week on the 10-year, where we closed at about 3.13%. And so now we're just kind of in between this tight range between 3 and 3.25 or so. And so if we see a break above the 3.25, then it's possible we could be heading up towards maybe as high as 4% on the 10-year, which we haven't seen in quite some time. So we'll be keeping a close eye on that and see where these rates potentially will top out. I can't imagine we'd get much higher than 4% on the 10-year. I'd be really shocked to see that. But I've also been pretty shocked with these rates this year in general. So I honestly didn't, probably if you asked me 3 months ago, even I don't think I would have bet that we would have got above 3%, and here we are above 3%. So we'll keep an eye on those charts though. And then taking a look at the 30-year, we got up 2 weeks ago where we topped out just about 3.5% on the 30-year, finished the week out at 3.26%. Looks like as long as we're between this 3.22 and 3.47, we may have some sideways action until we see a clear break either above or below those levels. And then we saw a nice drop in the VIX finally. The VIX has been floating around above 30 for a while now, and anytime we're above 30, that's generally not good for the markets. Usually it means a lot of fear, a lot of volatility in the markets. And while you can have some up days when you've got a VIX above 30, generally speaking, it's a bit of a warning signal. And so the fact that we rolled over below the 30 level for the first time in a few weeks, it was a bit of a bullish signal, and obviously we saw a nice run in the markets this week. So as long as that VIX stays below 30, I think that's a bullish sign for potentially some more upside in the markets in the short term. And then looking at our put-call ratio, anything above 1 is considered elevated put buying protection. We have dropped down below that range now, so now we're kind of in a more normal range in the put-call ratio. And so as long as we're below that 1 level, it doesn't look like there's a whole lot of people spooked in the market. and buying a bunch of protection like we were seeing for quite a few weeks in the previous few weeks and a couple months really. So let's go ahead and finish it up with a couple of crypto charts. We'll go ahead and do Bitcoin first. We had a pretty big drop about a week or two ago where we got all the way down to this anchored VWAP position. We fell all the way to about 17 and change or so, and but that quickly recovered, got back up above 20,000, and then we just kind of been chopping around just right around that 20,000 level, slightly above. We're currently on Sunday when I'm recording this is about 21,000 on Bitcoin currently, and as long as Bitcoin's holding that 20,000 floor, we could be potentially looking for some trade opportunities in some of these altcoins for some upside. And the one that I'm in currently is Uniswap, so it's ticker UNI, and I got into this one a few days ago after we saw a clear break above the 50-day moving average. So I got in this one probably just a little over $5 a coin, looking for some decent upside as long as Bitcoin holds that 20,000 floor, and as long as Uniswap is sitting above that 50-week or 50-day moving average, then I like it long. First price target I'll be watching closely is this 100-week or 100-day moving average, which probably will end up settling down right around the $7 mark. So I'll be looking for at least a $7 upside on this trade currently. And possibly if we get above that level, I'd say probably the best case scenario would maybe be we get all the way back up to say 880 or so a coin. But if we get to that level, I'll definitely be taking profits there. But I'm also going to be watching really closely at the $7 level on Uniswap. So thanks for tuning in this week. Make sure to like and share, and download the ToroAlerts app on the App Store. You can get one for stocks and one for crypto. And we'll see you next time.